From the financial centers of the world, this is Bloomberg Markets with Alix Steel and Guy Johnson.
Friday, yes, Friday, the 15th of October, 3 p.m. in London, 10 a.m. in New York, 30 minutes into the trading day in the United States. From London, I'm Guy Johnson. Alix Steel, of course, over in New York. Alix, retail sales strong. You've clearly been shopping. Goldman Sachs knocking it out of the park, and I get to go on a road trip.
I mean, yes, all three amazing things. We're very excited about planning Guy's trip here. We're deciding what we're going to do, maybe a Rangers game. Okay, well, as Guy pointed out, earnings, good. Data, good. Stocks, good. Up by 0.6%. But the outperformers in the S&P are what Guy's talking about. You have Norwegian Cruise, you have Carnival, you have the airlines, all pushing higher as now you can have vaccinated travelers can enter the U.S. on November 8th. Small caps really pushing higher, outperforming all the major indices. And all of that, surprise, surprise, leads to higher yields. Pushing higher again, up by 5 basis points. We're still down here on the week for the 10-year in terms of the yield, but we're still 1.56. So that pushing higher as well, helping financials. I just want to point out zinc at the highest level since 2007. Copper catapulting higher as well. This is continued issues from the higher energy prices into curbing some mine supply. We'll talk about that later on in the show. Guy?
Absolutely. And we've got data to deal with. It continues. We've got University of Michigan out. It was interesting that retail sales were so strong when you think about the data we're getting here, because University of Michigan sentiment index coming through at 71.4. That's down from 72.8 last time round. The market was expecting it to tick up to 73. So a little bit of a misprice, you could argue, vis-a-vis the retail sales numbers. Current conditions, 77.9. That, again, a dip and below expectations. Future expectations, 67.2. Again, a dip and below expectations. However, now we get to the kicker. 1-year inflation expectations, 4.8. That is up from 4.6. 4.8. Gas prices have certainly risen. And 2.8, Alix, on the 5 to 10. So 5 to 10, I'm not sure that's transitory. But nevertheless, the consumer certainly sees inflation right now.
Yeah, but the 5 to 10 is sort of lower than it was the previous month, which is also interesting. We're going to dig into that in just a second. We want to follow all the top stories for you this morning. Bloomberg's Michael McKee is looking at that surprise jump in retail sales. Bloomberg's Shanghai Basak is going to break down Goldman's earnings. And Sid Phillips is following the U.S. decision to open its borders to those vaccinated travelers. So let's start on the eco data. I was shopping. I told you guys this. I was an early indicator. Bloomberg's Michael McKee looking deeper into those retail numbers. Mike?
Your country thanks you, Alix. Guy, to your point about trying to figure out the difference between confidence and retail sales, Alan Greenspan had a famous saying once, we watch what consumers do, not what they say. But it is probably gasoline prices that's driving the inflation views and the negative views of the economy that we have seen. But it has also helped boost retail sales because retail sales are denominated in dollar values. And here's the surprise. Last month revised higher to 0.9%. This was supposed to be a negative number, but instead we rise 0.7% as Americans do go to the store, but they also paid more money for it, which is interesting. And then you look at the retail control group, this is what goes into GDP, again revised higher, which suggests maybe this one will be revised higher, but both are positive. Import prices, and this is where oil comes into it. Last month it declined, and this month import prices went up 0.4%, but that was almost primarily all due to the higher price of oil. The Empire Manufacturing Index drops by half, but they still characterize that as strong. They're saying the biggest problem is supplier delivery times. They can't get stuff to make stuff. Now, let's take a look at what was going on with cars, because car prices are, the retail sales are denominated in dollars, as I mentioned, and so you have this unusual situation where unit sales fell off a cliff down to 12 million during the month of September, but look at what happened. Retail sales version of cars goes up. So some good news there, at least in terms of what people are paying, but maybe that's because of inflation again, the used car prices that went up. And then here, retails, this is the bars and restaurants. And I know Alix didn't do any of this. She bought clothes, right? She didn't go to bars and restaurants. Yeah, but they were up. I mean, it's just slightly, but they were up, which shows that people just didn't give up and go back into their homes for the Delta variant. They did go out, so maybe that bodes well for the future.
Yeah, Alix has now been out and eaten indoors. So
one time.
This is, yeah, once. But once becomes two, What are you doing this weekend? Maybe you're going out again. Starts to kind of snowball a little bit.
Snowball a little bit, yeah.
And it's getting cold outside. To the snowball reference. Mike, thank you very much indeed. Let's turn to the other element that Alex was mentioning at the top, and that is what is happening with the earnings story. Goldman Sachs hired this morning. It knocked it out of the park. Record revenues in the third quarter. It's on track for its best year ever. Here with more details, Bloomberg's Wall Street correspondent, Sonali Basak.
Yeah, that's the best year ever in terms of revenue. They are absolutely beating expectations, and as well as ROE. They're beating their own expectations of themselves, as well as Wall Street's expectations of them. You have equities trading at $3 billion, not ignorable. It's better than anybody else on Wall Street, including Morgan Stanley, the traditional leader in that business. Investment banking fees soaring. And it's worth noting, they do say that the backlog for this quarter is a little bit lower than it was the prior quarter. However, still very elevated relative to the prior year. Goldman Sachs on our league tables is currently number one, followed by JP Morgan and Morgan Stanley. So firing all cylinders, consumer business also much higher, Guy.
Yeah, it was super solid. Sonali, you'll be back when the call starts at 10:30. Thank you very much, Sonali Basak. And later today, tune in to Sonali's interview, exclusive interview with David Solomon, Goldman Sachs chairman and CEO. And the good news for Guy, I'm deciding what to bake, we're deciding what to drink, we're deciding what to do. The U.S. can open its borders to vaccinated foreign travelers on November 8th. Here with more is Bloomberg European transport reporter Sid Phillips. Sid, what's the upside here?
So the airlines have been asking for this for months, and they're finally going to get their wish. And that means that travel can get restarted again. People can actually start going to the US after months and months of lobbying. And that's great for carriers like British Airways and Lufthansa, which depend a lot on premium business on the US sector.
Sid, what are the requirements? What needs to happen to actually for me to get on a plane and go to the United States? What am I going to have to do? How many hoops am I going to have to jump through?
So you need to do a COVID test 72 hours before flying. The other details, you need to be vaccinated. Of course, the US isn't allowing in unvaccinated non-Americans. They'll still allow Americans who are not vaccinated in with a COVID test, but unvaccinated Americans, non-Americans will not be allowed into the country. And while the details are still a little short, they have said they're going to accept WHO-approved vaccines. So that sort of puts the question whether it'll only be US-approved vaccines to rest.
AstraZeneca looks like we might get a tick in the box for that one.
For you.
Sid, thank you very much indeed. Well, Alex, that's a critical factor because there was some concern, certainly here, about what was happening if you had Astra, because the US hasn't cleared that yet. I love the fact that Alex's first reaction is, I must bake something.
Yeah. Yeah, we've got to show the appreciation.
Yesterday,
I'm gonna go buy food. I'm
yesterday,
bake things.
You were laughing at me because I made pizzas. Now we're talking about you baking. I'm not sure that the two are that dissimilar.
No. I'm totally up for baking my own pizza. I'm just saying, like, in a pinch in the middle of a school week, having to make the dough feels like a lot. But your point is, so do you like croissants? I asked, you didn't answer.
I love a croissant, yeah. I'm very happy for all of these things to happen. One of our other producers is suggesting a Rangers game, which sounds like fun.
Croissants at a Ranger game.
There are other things on the itinerary.
Yeah.
We could do, yeah.
Anyway,
I look forward to the Rangers game. Apparently, there's one just after the 8th, just after the 15th, which is when we potentially could be doing this. So we'll see. Rangers game sounds good.
Really
let's talk about what is happening with consumer sentiment. We digress. We just had the UMich numbers. Let's bring in the man who heads up the team doing that survey, Richard Curtin, University of Michigan Surveys of Consumer Research Professor and Director. Thanks for joining us as ever to break these numbers down. What's my takeaway, Richard, from these data?
Well, thanks for having me back. I think the main takeaway is that consumers have remained rather pessimistic in these past 3 months, largely unchanged in the level of their sentiment, although most of the increase was balanced out by a decline. And that was between the income groups. The bottom third of the income distribution was clearly more optimistic, and the top third, mostly the top two-thirds, was more pessimistic. And, this follows the supply lines difficulties and labor force participation difficulties. But it also reflects what consumers think about the future of inflation and unemployment.
Yeah, so Richard, can I just stop you there for a second to dig into that a little bit more? Because I was interested in that the one-year inflation expectation rose 4.8% now, but the 5 to 10 year is still 2.8, so it's higher than 2, but it's under 3, which is what we were the previous month. What is that telling us about the consumer's short versus medium-term trajectory here?
Well, I think consumers have lost the notion that it will be transient. Over the past 6 months, the year-ahead inflation rate has remained on average at 4.6%. Over the first year of the pandemic, it was just 3%. So they no longer think it's going to be transient, but they do think that the Fed will act soon. 73% of all consumers expect the Fed to raise rates during the year ahead. And that could be why that they expect the longer run inflation rate to come down or is below the short-term rate because of the Fed's actions.
In terms of, can I just ask you, Richard, we had really strong retail sales numbers today, which seem to indicate that the consumer is feeling fairly good about life. And as we heard at the top of the show, you judge the consumer not on what they do, but what they say. So I'm wondering how I put these two pieces of data together. You're pointing to a consumer that's looking a little bit more cautious. The retail sales number tells a different story.
It does, a slightly different story. Of course, retail sales are in dollar terms, and if you converted them to real terms, though, those gains would largely disappear. And the gains in retail sales really reflected higher prices for energy, for used cars, and so forth. So I'm not sure that they're so inconsistent. Our data has usually followed the real increases, inflation-adjusted increases. But let me say one more thing. There's a less tangible factor going on now, and it has to do with confidence in government economic policies. In the past 6 months, confidence has really declined in how consumers view the ability of the government to manage the economy. In April, it was 31% was thought the government was doing a good job. That was Biden's peak, and now it's down to 19%.
Richard, on that point, what's the why behind it? Is it infrastructure? Is it debt ceiling? Is it COVID? What is it?
I think, the old saying, don't let a good crisis go to waste. Consumers think that the sum of the programs being advocated is just too much and too risky when they need help now. And so I think that that's it. And, it's that we've seen this before. Yeah. And these sort of fiscal cliffs have occurred repeatedly over the years. Yeah. And we need to look at that. Consumers in the past mentioned those things very often in our open-ended question. Yeah. Today, only 3% even talked about any of the proposals or the debt ceiling. But what they mentioned is that they just don't have any more confidence, or the confidence in government policies has been reduced.
Richard, we do have to leave it there, but we keep on trying to understand how DC influences markets, and this feels like that's the connection we've been looking for. Richard, thanks a lot. Richard Curtin, University of Michigan Surveys of Consumers Research Director. All right, coming up, you got inflation fears are driving some bets against treasuries. We're going to break down the market structure right now with Andrew Beer, founder of Dynamic Beta Investments. This is Bloomberg. Well, one big move that we've seen in the markets this week has been the re-rating of the 10-year. Overall, sure, we're down, but the last couple weeks has seen a really big rise in yields. And quants are really building those bets against Treasuries. So this comes from us from Dynamic Beta Investments, and it tracks the ETFs in terms of positioning. So as you can see here, the yellow bar is what those positions were back in March 2020, and the orange bar is what they are as of October 12th. And you can see here that you're seeing a big build in short rates ETFs, intermediate rates ETF, long rates ETF. The lower it goes here in negative territory, the more short they're going to be. And you can really see the change in sentiment just over the last, say, year and a half. And I guess the question becomes, how much more does that have to re-rate as well? Andrew Beer is Dynamic Beta Investments founder, so responsible for this data. Andrew, walk us through the significance of just how short the market actually is when it comes to rates.
Well, I think the thing you need to understand, and first of all, thank you very much for having me on the show today. It's a pleasure to be here. So the data was covered in a terrific article by Justina Lee, and she looked at and spoke to a number of people in the quant space. And I think the thing for viewers to understand about the quant space is mostly what they're trying to do is understand what the market is telling us about where rates are going to go and what economic conditions are going to be like. And essentially, they're saying three things. They're saying, first of all, rates are going to keep going up, and we see that expressed in short positions in treasuries. They think the supply chain issues are going to continue on the commodity side. We see that in long commodity exposure. And there's a sort of meaningful view that the China contagion will continue. And you see that reflected in emerging markets. And so, I think the thing also to understand about this, though, is that when you look at that chart, you see that these positions do change over time, and in 3 months we could have a different view on it. But there's a pretty distinct and clear view from quant hedge funds today.
Okay, let's just talk about that a little bit more. You talk about the possibility of it being very different in 3 months' time. Trend following is obviously something that has turned out to be highly effective for the quants. The models are based on a lot of this, and I'm wondering what your expectation is for the kind of volatility we're going to see. How stable are these trends?
Well, I mean, on the trend following side, so why is trend following, first of all, an interesting investment? It's an interesting investment because markets tend to be very emotional and they tend to overshoot fair value. And it also takes markets a while to incorporate new information. And our sense is that right now we're in the middle of a big regime shift. We've gone through a decade of essentially negative real interest rates. And it wasn't until late last year where we started writing about the fact that hedge funds were very, very early to embrace the view that inflation was going to come back. That said, how inflation is and what inflation looks like is a very dynamic thing. Early this year, we had this view, or hedge funds had a view that inflation would be very positive. It was going to be demand driven. Everybody had tons of money. We were all going to buy stuff and things were going to go up. And in more recent months with the Delta variant and a slowdown in economic activity, the fact that inflation has been stubbornly high has been much more on reflecting concerns on the supply side of the equation. Mm-hmm. So I mean, our general view, what makes, we wrote a paper in early this year about the fact that if you're concerned about inflation, managed futures and trend following is an incredibly effective strategy because how the market interprets this will change over time, and the strategies are quite good at capturing that.
So, Andrew, let's go to something else you talked about, that one of the biggest fears of what's happening in China. And you also sort of tracked what happens, say, with U.S. equities, emerging market equities, and the dollar. And I was really struck by the change in sentiment for EM, but also for the dollar, which obviously are so interrelated.
Yeah, so it's, I mean, for us, it's been very interesting to watch as well. So I would say broadly, hedge funds have been very constructive about equities all year. I think the general view has been if you had to put $1 into equities versus fixed income, it's a no-brainer. Put money into equities. The composition and underlying it has changed a lot. There was a big value thesis that hedge funds embraced toward the end of last year that shifted into more of a growthy view, and now it's somewhere in between. But I think on the emerging market side, that's actually been quite interesting because you would think that in an inflationary environment on the commodity side, that's generally historically been very good for emerging markets. And the huge hedge fund theme of the middle 2000s was you want to buy bricks because in part we're in the midst of a commodity boom for a lot of reasons. And in a sense, over the past several months, China has been such a big idiosyncratic factor with this kind of mysterious, confusing economic crackdown that in fact you've seen a divergence between emerging markets. So quants historically would have been long both emerging markets and commodities, reflecting a similar view, and now it's actually the opposite. They're long commodities but short emerging markets.
Andrew, just to wrap this up, the 60-40 is dead, right?
Yeah, well, look, I think fixed income has huge issues right now because as we learned in March of last year, a traditional corporate bond portfolio can get destroyed by credit spreads when they blow out 5 times. And then we saw earlier this year that when rates go up, it's equally bad. And I think what's happened now is it's turned positive. So when people talk about hedge fund demand, a lot of it's coming from fixed income. People are just giving up on traditional fixed income as a long-term play. And so I think it's going to push people to look for diversifying strategies. And if you're concerned about inflation, again, we think managed futures should be at the top of your list.
Andrew, really interesting conversation. Thanks for bringing it to us. Andrew Beer, Dynamic Beta Investments founder, greatly appreciated. What are we going to do next? Bitcoin jumping. Regulators apparently poised to allow trading of the first Bitcoin ETF. That's set the world alight, at least the Bitcoin world, the crypto world. We'll talk about it next. This is Bloomberg. From London, I'm Guy Johnson. Alix Steel is over in New York. This is Bloomberg Markets. Alex, let's talk about what's happening in ETF land. ETF Friday, we like to call it. The SEC poised to allow US Bitcoin futures, according to people familiar with the matter. It's an ETF that obviously is going to potentially completely change the landscape. It's pushing the cryptocurrency higher. Let's find out what's going on. Here's Dave Wilson.
Well, here's what's going on, Guy. You've got the digital currency up above $60,000, pushing toward its high of $65,000 in April. And the key word in your introduction was futures. I mean, you've seen efforts to set up a Bitcoin-related exchange-traded fund going all the way back to 2013 with the Winklevoss brothers. But it's only after the introduction of Bitcoin futures, late 2017, that we're kind of have come to this point. And so we've had people familiar with the matter telling us that U.S. regulators aren't going to stand in the way of Bitcoin futures ETFs. We may get the first ones next week from ProShares and Invesco, 3 more potentially over the next 2 weeks. So ETFs, Bitcoin, well, it's coming, and it's just a matter of what happens next because, we've certainly seen the currency move up in response.
Yeah, I had a kid in that time. Who's now 7. To your point, it's taken her a long time to get here. Bloomberg's Dave Wilson, thanks a lot. Really appreciate it. Well, as you just saw, we have some really great guests coming up for you, so stay with us. You got Jim Coulter, TPG founding partner and executive chairman, will be joining us. We're going to talk about where he is finding opportunity right now in this market. This is Bloomberg.
Approaching 5:30 live from London, I'm Guy Johnson. Alix Steel is over in New York. This is Bloomberg Markets. Alex, I'm still slightly perplexed by the gap between the readout from University of Michigan consumer confidence data and what we saw in retail sales. Retail sales was surprisingly strong and pretty much across the board, which I think caught a lot of people on the hop. There was an expectation that inflation, et cetera, would be eating into demand. People wouldn't be going out and shopping and spending as much. That looks great, but the University of Michigan data does not look great. And it was interesting what Mike McKee said at the top of the show. He basically said, you know what, you watch what they do, not what they say.
Right, exactly. I think there's also the distinction to be made about retail sales being more backward-looking and encapsulating some back to school.
Yep.
Also, those higher prices leading to a higher overall figure versus the sentiment that's forward-looking. And the UMich sentiment is the second lowest level since 2011. So much more pessimistic about the future that does have to do with inflation. And I thought it was interesting what Richard Curtin was saying, that they feel really bad about what's happening in D.C. They feel really uncertain. And we talk a lot about, well, does the debt ceiling matter? Does a fiscal cliff matter? We don't know how that translates into markets, but this may be one pass-through to that. And you can see the S&P off the highs of the session, yields off their highs of the session.
Well, it's interesting because in some ways, we have got used to the largesse that DC has delivered. And now it's starting to look a little bit trickier. So the largesse is certainly running into the sand at the moment. We don't know what it's going to look like, and therefore the consumer maybe looks a little confused as to what is happening in DC. No confusion on Wall Street, though, Alex. The numbers absolutely sensational out of Goldman Sachs.
Yep, really, really good. And then the performance of the stocks after that, also quite interesting. Goldman off the highs, but still up almost 2%. The call is starting. Bloomberg's Shalai Bassick joins us now with more. What are we expecting to hear? What are you looking for?
Yeah, some of the things I'm looking for is the outlook moving forward, Alex. So, for example, how long can these trading figures continue to be booming as they are, both in equities and in fixed income? Also, the sustainability of that massive revenue jump that we're seeing in the advisory and underwriting businesses. Remember, Goldman is transforming quite a bit as well. So we want to hear details about what the asset management business will be looking like, their own kind of merchant banking-like activities where they're going to be deploying more capital. We know that that is a strength that is pretty unique to Goldman Sachs relative to its peers. And separately, the consumer business updates. They have not yet integrated Green Sky, which they announced pretty recently as an acquisition, but those consumer numbers have already jumped past expectations. More than $2 billion brought in the consumer and wealth management revenue. We heard from Morgan Stanley yesterday that they are hiring and they are bringing in many teams when it comes to wealth management. So as Goldman reshapes their business, how are they competing?
And what happens with cost? That seems to be the critical factor here as well. We've been hearing time and time again that these bank CEOs certainly are talking about higher costs, but they seem fairly comfortable with it. What about investors?
Incredible. Jeffries is already pointing out that the operating leverage Goldman has attained is one of its biggest benefits. Their comp ratio is only 23%. It's below what you see for most of the market. And their efficiency ratio is also just very, very, very productive right now. So you have levers over at Goldman in which if they increase pay even more, they would still be well below what even they have expected in terms of their own efficiency. So we'll see what that means in terms of David Solomon's own plans for compensation at the end of the year. Of course, it's pay for performance, and his folks have done very well. And hiring as well. You and I both had, we all had talked to James Gorman yesterday. They are hiring, and so is Goldman Sachs going to be saying the same thing.
When you talk to people on the street, do they think that this is the top for these guys? Like, is this like the best stock performance you can get, the best news is priced in?
It's interesting because on some, there's a real worry about that. But volatility is not always a bad thing. Remember, Morgan Stanley yesterday had said fixed income was weaker mostly because credit spreads were so much tighter. And so a little bit of trouble might not be such a bad thing for some of these businesses. And we know that in elevated volatility, the equity underwriting has continued at such a fast clip. And let's not forget, their clients, both of these folks are huge bankers to the private equity industry, which is just sitting on so much dry powder.
In 10 seconds, what's the key question?
It's comp. I mean, at this point, it's still about talent, to your point, but the numbers are good, and let's see if it can continue.
Sonali, we're looking forward to the conversation you're going to have a little bit later. Thanks for spending some time with us now. Sonali's interview later today with David Solomon, Goldman Sachs chairman and CEO, is going to be a must watch here on Bloomberg Television. Really looking forward to that. Let's turn our attention to the production line, I guess you could call it, for the likes of Goldman Sachs. Stanford, once again, being named the top U.S. business school in the latest Bloomberg Business Week Best B School MBA rankings. Let's go to Carol Massa, Tim Stenovich, who are on location in Stanford.
Guy, thank you so much. We are on location in beautiful Stanford and at the Stanford Graduate School of Business. And you're right, this is one of the main schools that is pushing out the future workforce when it comes to all types of businesses. And it also pushes out some pretty prominent alumni, including Jim Coulter, who was class of 1986 here at the Graduate School of Business. You know him well. Our audience knows him well, of course. A co-founding partner of TPG. He is also now the executive chairman, co-managing partner of the Rise Fund, which was founded in 2016. Got a lot to talk about. Jim, thank you so much for joining us.
It's a pleasure to be with you, and I admire you being on the Stanford campus.
It's a little chilly. We want to talk about your time here, but we also have to ask you, there are so many big macro issues right now that we talk about nonstop. Guy and Alex do it on their broadcast, Tim and I do it, whether it's about transitory inflation, whether it's, what's going on with China, what will be our relationship going forward. We talk about the future workforce. We talk about the climate. What are the macro issues that really guide you in your thinking?
At the moment, I'm focused on long-term issues. I think we're in a period of high volatility, but as a private equity investor, I'm thinking about next year, next decade. And for me, the top issue has been climate, which I think is the leading opportunity, in some ways the leading risk as we think on a decade basis.
To what extent is climate driving your decision making right now? We just saw earlier this week you, along with another firm, making a big investment in Tata Motors to the tune of $1 billion. I'm wondering what other opportunities are exciting to you apart from electric vehicles right now. Where else are you thinking about deploying capital?
You know, we are seeing opportunities across the climate landscape, from batteries to hydrogen to carbon capture and storage. At the end of the day, Tim, Carol, we're on the front end of what will be a major industrial revolution. Some have called it the most consequential common action we'll have to take as a species for the next 30 years. And in that is a responsibility for business and an opportunity. We're focused on both.
I think we're having some technical problems. Unfortunately, I'm not hearing Jim. I'm not sure if you are.
I'm not hearing Jim either.
So we're hoping we can clean that up for a second and get back to Jim Coulter. Of course, we're here at the Stanford School of Business and talking to him a lot about, we want to get into the RISE Fund and their investments, because they're capping it about $7 billion. And they did make that an investment just this week with Tata in terms of EVs and batteries. So that's really significant. So we're going to hopefully get back to Jim Coulter, but right now we're going to send it back to Alix and Guy.
All right. Thanks so much, guys. Sorry for that. That's never fun when that happens in the field. But stay with Carol and Tim throughout the day. They're going to have some really great interviews. Hopefully they'll have a Jim Coulter coming back as well, because later today they'll be speaking with Dara Treseder, Peloton's Chief Marketing Officer. And coming up right here on this program, credit investment firm Sycamore Tree Capital Partners is sounding out its first CLO sale. We'll try and get more information from Mark Okada, the co-founder. This is Bloomberg.
This is Bloomberg Markets. I'm John Hyland, live in the principal room. Coming up, Nigeria's Minister of Finance, Zainab Ahmed. That's at 12:30 p.m. in New York, 5:30 p.m. in London. This is Bloomberg.
A credit investment firm, Sycamore Tree Capital, is said to have started sounding out investors about its first CLO sale. That's according to Bloomberg. Joining us now is the man behind it, Mark Okada, Sycamore Tree Capital Partners co-founder and CEO. Also with us is Bloomberg's Eric Schatzker. Eric, I'll kick it over to you for a few.
Thank you very much, Alex. Mark, it is great to see you here at 731 Lexington, back in New York City, traveling. Thanks for coming.
Well, thanks for having me. It's been over a year and a half since I was back in the city.
Amazing, isn't it?
Yeah.
You're based in Dallas. That's important for people to know. You've also been active in fixed income for more than 30 years. You were behind the first CLO back in 1996. How frothy is the credit market right now?
Well, everything's frothy, right? This wall of liquidity is affecting everything. I would say as we look across all fixed income, all credit asset classes, there is no shortage of money. I was talking to a dealer this week, and we got the quote is, there's an infinite amount of liquidity a quarterback. So that means that the money's there. But on the other hand, there are parts of the market that are more rational. And one of the areas that we were just talking about is floating rate credit. And we like that.
The loan market.
Yeah, the loan market, the securitization of the loan market, which is what CLOs are. That market is much more rational.
Relative to the bond market.
Absolutely, absolutely.
Just to be clear, you're saying that in terms of valuations, frothiness, the bond market is, in your eyes, more overpriced than the loan market.
Take high yield bonds, right? You got high yield loans, high yield bonds. High yield bonds are at 300 over. The year ahead look is probably to stay at spread maybe, but you're pricing out the 5 or 7 year. And if the curve steepens the way it has been and probably will be, you make no money there. That's not a great value opportunity. Loans have beat the ag by 600 basis points already, and we still haven't seen rates move.
Mark, there are so many lively debates about the economy right now, whether we're heading into an inflationary cycle, how long the supply chain squeeze is going to last. What is your loan portfolio telling you about the economy? about those things and also about hidden strengths and weaknesses?
Sure. I would say it's, instead of stagflation, it's a dragflation. We've seen a lot of drag on the corporate execution coming out of the pandemic. Companies are dealing with a lot of supply issues, which this is pretty obvious to everyone on your programs and I think in the market. But on the other hand, demand is there. Demand is there for top line. So the question now really is, how is this endemic like COVID, or is this something that is transitory and will go away?
Answer the question.
I'm in that it is much more long-lasting. But on the other hand, I don't think that demand dissipates either. I'm not in the camp where prices rise to the point where we kill demand, or the Fed makes a mistake. I think the Fed will be very late here. I do think that the Fed will not raise rates next year. But even if they did,
if they said they're going to, you think they're going to chicken out?
I don't think that they are in this place where changing the game as far as negative real rates actually gets them anywhere. It doesn't help with supply. It doesn't change the problem. So that's that answer, that historical answer where demand is always the thing that we're trying to stimulate, is not the case. So that's not going to happen. So we're calling for a longer cycle, a longer economic expansion, going to be lower, and we're going to be dealing with higher prices. The reality, though, as far as markets are concerned, markets have figured this out pretty much. I mean, look at the strength that we're seeing, all the things we were talking about. You haven't had a moment really in the credit markets where it said, okay, game over, right? There are no defaults. There's very little stress. Everything's priced to perfection, but that's not going to change per se. I think that stays the case, unless there's only one scenario where I get a little worried at this point, and that's the technicals, right? If you look at what the story from this year on the rate environment is, the 10 years kind of ignored everything, and it's kind of just sat there. And the reason it's ignored everything is technicals. The Fed's been buying everything up, and there was a point there, actually, Eric, where they bought every bond. They were the whole market, because the net supply was negative, was shrinking. So we're past the debt ceiling, and demand's growing, and supply is starting to grow, and they're going to taper. So could we get a 200 basis point 2 to 10 year spread? Yeah, it could happen. That would, I think, put a little bit more fear in the greed, pond. But I don't know. I mean, we'll see. We'll see if that happens.
Markets, Alix here. It's really good to see you in the building. 200 basis point jump in that spread would be quite significant. And I'm wondering, where would we see the effect of that? Where would the froth shake out the fastest, and what would you be selling kind of into that fear?
Well, like I said, I'm not afraid of inflation because I'm prepared. So everything we're doing is floating rate. That's not going to hurt us per se, because this is happening in a strong economy. That's going to crush anybody who's got some duration. And it'll be interesting to see how that comes. And duration today is not just bonds. I mean, you've got a lot of long duration growth equities that will probably struggle. Alex.
Yeah, and just to follow up on that, in terms of then the CLO market, it's been so hot. Bloomberg has reported that you're going to be marketing one. How's that going? Can you give us some details of that, particularly in this environment?
Well, I'm not going to talk about specifics, but Alex, but look, we're coming up on our first year of the new firm, but this is not our first rodeo. It is amazing to see how big the world has gotten. In COVID, what happened was our competitors that were big got bigger. And now they're at this point where the ability to create alpha is very challenged. You're the market. You're so big, you're the market. So we can come in here and figure out what we think the best risk return is, and that's what we're talking about, and that's what we're going to do. And we're being selective, and it's actually kind of nice being small and starting up. But we'll see where that goes. I'm very, very constructive on what we're doing in the markets that we're doing, but we have the luxury of being able to do that.
Mark, what we've been talking about is the beauty of supply and demand and how it creates price discovery in the capital market. You're based in Dallas.
Yes.
You've been there since 1994. You were early. As you probably know, Texas has passed a law punishing banks, right, for limiting their business with gun manufacturers. And it's blocking JP Morgan, and it's blocking Citi and B of A and Goldman and others from underwriting muni bonds. And I want to ask you a philosophical question. Can we have a real capital market if governments make political decisions about who can and who can't participate?
Wow. I do think that political uncertainty and the environment that we're in is one of those drags that we were talking about earlier. I'm not going to get into that specifically, but I will tell you.
Doesn't affect you from what I...
No, it doesn't. I would tell you that where we do business and why we do business there is something that people will put into their calculus as to why they do what they do, where they do it, and they will adjust. You see people moving into Texas for a reason, because the capital is treated better there. The people are treated better there. We're just opening up our New York office. This is a great town. You need to be here for various reasons. So there's this need to position yourself and your capital and your business in a way that makes sense. Now, there are certainly a lot of things going on in the broader macro discussion that may give you pause about some of this, or may limit your ability to actually execute on those decisions. And that will be just more sand in the gears. However, I am very, very convinced that we will get to this place where this idea that things are more endemic or more long-lasting as far as factors, and you adjust to them, and then you move forward. So some of these
well, hang on a second.
Yeah.
You're not telling. Surely you're not telling me you want politics to be one of these factors.
They're going to continue to be. We've had so much political volatility. If you just look at a graph of how the people are coming out, look what's going to happen in the midterms. We're going to have 50 seats or something. It's going to flip the other way. This volatility continues. And that is just a reality of the way we all have to sit in and look at risk and look at markets and then do something about it. And I think that that's an opportunity, really, versus maybe something to get too worried about. So I think that's an opportunity. I'd love to see a little more volatility in general. It's really been interesting to see how we've got a little bit of it and then it kind of peters out. Some more of that would be good.
Guys, thanks a lot. We really appreciate the time you both gave us today. Mark Ocado, Sycamore Capital Partners, and Bloomberg, Jared Schatzker, thank you so much as well. This is Bloomberg. All right, every Friday, Guy and I are here. We do our favorite charts of the week. Guy's going to roll his eyes because mine's commodities. But this is copper storage warehouses in LME and Shanghai. You have the white line is Shanghai and the blue bars are LME. They're both down. Usually there's a nice arbitrage between the two where you see traders playing that. Can't do that this time. Both of them are lower. Does that mean even higher copper prices? Now over $10,000 a ton.
Shocker, Alex does commodity charts.
I didn't do one last week, though. Come on, man.
No, to be fair, that caught me completely on the hop. But I think, was it my bond chart last week or was that the week before?
That was the week before.
James Bond, that is.
Yeah.
Let's talk a little bit about this chart here. Diwali's coming up, so maybe an opportunity to celebrate in India. What you've got here is the market cap of the Indian stock market and the market cap of the UK stock market. Now, this is just primary listings. But in India right now, you've got super low interest rates, and you've got a retail boom, retail investing boom, that doesn't quite match what is happening in the United States, but isn't too far behind. And as a result of which, what you've seen is an explosion higher in terms of the Indian stock market. So we are basically on the cusp of the Indian market overtaking the UK market by market capitalization. That will put it in the top 5 in the world, which is interesting when you think about what is happening as people rotate money out of China, Alex. However, once you put primaries in, once you put ADRs in, the game looks a little bit different. But nevertheless, I think an interesting moment coming up.
Sure, yeah, but I have stockpiles. Just saying.
Okay, you got copper. That keeps you happy. Okay, European close is next. This is Bloomberg.